What if I told you that the absolute best case scenario for a retailer today involves a crippling winter storm, a totally tapped out lower income consumer, and just a terrifying wave of competitor bankruptcies?
I mean, it sounds like a nightmare for anyone else.
Right, because while the traditional physical retail sector is shrinking and fighting for its life and, shuttering thousands of locations, we are looking at one specific company that just used that exact apocalyptic formula to print a massive revenue jump.
Yeah, it's wild.
Welcome to Talk Tickers. Today's deep dive is zeroing in entirely on the Q4 and full year 2025 earnings call for Ollie's Bargain Outlet. Ticker symbol is OLAI.
And, our mission for you today is really to pull apart the mechanics of how a discount retailer is actively weaponizing industry-wide panic into this multi-billion-dollar growth engine.
Yeah, weaponizing is the right word. Because if you watched the market's real-time digestion of this quarter, it was basically a masterclass in behavioral finance.
Oh, absolutely. I mean, this was a pre-market call. So the moment the numbers dropped, we saw this immediate pre-market pop of over 3%.
Right, the algos just loved it.
Exactly. Institutional algorithms, early retail buyers, they saw the top line growth and the aggressive store expansion, and they just hit the buy button.
But then, as the regular trading session wore on, that aggressive buying cooled off significantly.
Yeah, it really faded. It eventually settled to a much more grounded 1.45% close.
Which is still constructively bullish, right? But that fade tells a very specific story.
It does. It says institutional money is demanding proof of concept on a few highly specific operational metrics before they, fully commit their capital.
So let's lay out the raw data so we can start dissecting the machinery behind it. Because on the bottom line, their profitability is just a fortress.
Totally.
GAAP and adjusted EPS came in at $1.39, which slightly beat the street's estimate of $1.38.
And that's a massive leap from the $1.11 to $1.19 range we saw in the exact same quarter last year.
Right, which basically proves their underlying margin structure is incredibly resilient, even when the macro environment is throwing curveballs.
Yeah, but the friction in the market's reaction, it stems from the top line.
Always does. So revenue hit $779.3 million.
Which is a 16.8% year-over-year jump.
Yeah, and in physical retail right now, nearly 17% growth is practically unheard of.
It's crazy. But it did narrowly miss the consensus estimate. Wall Street was sitting at $783 million.
So a $4 million miss on nearly $800 million in revenue.
I mean, it might seem like a rounding error to you and me, but in an environment where investors are looking for literally any excuse to take profits, any top-line miss gets heavily scrutinized.
Oh, for sure. But the redeeming factor here is the comparable store sales. Their comps grew 3.6%.
Right, and for anyone who doesn't track retail daily, that metric measures the sales growth of stores that have been open for at least a year.
Yeah, it strips out the artificial boost of just opening new locations.
Exactly. And a 3.6% comp in this discretionary retail environment, it's phenomenal.
And the forward-looking narrative is even more aggressive. Their fiscal year 26 guidance is basically a declaration of war on the remaining off-price sector.
They are not holding back. They're planning to open 75 new stores.
Wow.
Yeah, targeting roughly $3 billion in net sales and forecasting an adjusted EPS of $4.40 to $4.50.
The sheer audacity of that physical expansion is wild. I mean, to figure out how they are actually executing this, we need to look at the consumer behavior generating those comps.
Right, because hitting a 3.6% increase while simultaneously dealing with a slight revenue miss, it requires a really bizarre collision of macroeconomic crosscurrents.
So let's talk about the first major crosscurrent, which is the weather anomaly.
Yeah. And look, often when a management team blames the weather for a top-line miss, analysts just roll their eyes.
Right. It's the ultimate retail cop-out. Oh, it rained.
Exactly. But the data from Q4 shows that the disruption Ollie's faced was severe. And more importantly, it was highly concentrated on the absolute worst possible days on the calendar.
We're talking about massive, paralyzing winter storms hitting their core geographic footprint right around the Black Friday weekend.
And it didn't stop there. They got hit again by another major weather event during Ollie's Army Night.
Which is their exclusive high-volume loyalty event, right?
Yeah, it's huge for them. And then a third wave of storms hit at the end of January, directly impacting the close of the quarter.
See, if you were an e-commerce platform, A blizzard is a catalyst. People stay home, they get bored, they scroll their phones, and they buy stuff.
But Ollie's is fundamentally a brick-and-mortar treasure hunt. You cannot just browse their closeout deals online.
Right, you have to physically drive to the box, walk the aisles, and, discover the inventory.
So when you look at their footprint, which is heavily concentrated in the Mid-Atlantic, the Northeast, and the Midwest, those specific storm systems forced hundreds of their locations to close or severely reduce hours for multiple days.
And these weren't just random Tuesdays in October.
No, these were the peak shopping windows of the entire fiscal year.
Which makes that 3.6% comp increase incredibly revealing if you think about the math.
How so?
Well, if you lose hundreds of store days during your highest volume weeks, your overall foot traffic for the quarter has to be down. The only mathematical way to still print a 3.6% positive comp is if the conversion rates and the average ticket sizes were absolutely exploding when the doors were actually open.
Right. And that leads directly into the shifting demographics of their shopper base.
Yeah, because to drive basket sizes up that dramatically, the profile of the person pushing the cart has to be changing.
Historically, the deep discount closeout model relies really heavily on the lower income demographic, but management explicitly noted they are seeing notable weakness in that specific cohort right now.
I mean, makes sense. The lower income consumers' discretionary spending is severely constrained by cumulative inflation. They simply do not have the extra cash for treasure hunt shopping.
Yet the top line grew almost 17%.
Right, so a completely different demographic is stepping in to fill that void.
It is an aggressive, rapid trade-down behavior from upper income and middle income cohorts.
Wait, really? Like high earners?
Yeah. The household making $150,000 a year, who previously might have totally ignored an off-price closeout store, is suddenly feeling the squeeze.
Oh, because of higher mortgage rates, insurance premiums, grocery bills, all of that.
Exactly. They are actively hunting for extreme value just to maintain their standard of living.
You can see this behavioral shift perfectly reflected in the category data, too. The strength in the consumables category was the standout performer.
We are talking about food, basic household goods, laundry detergent, health, and beauty supplies.
Right. And when a treasure hunt retailer's strongest growth is in mundane consumables, that signals a consumer who is highly necessity-driven.
Yeah, they aren't walking in to buy a novelty rug or a discounted kayak. They are there to buy cheap shampoo and pantry staples because the traditional grocery store has literally priced them out.
And this demographic shift perfectly lubricates what management calls their disruption as fuel strategy.
It's such a unique model. The off-price closeout format doesn't just endure macroeconomic stress, it actively requires it.
Right. Traditional retailers operate on predictability. They want smooth supply chains, stable consumer demand.
But Ollie's requires chaos. Because traditional retailers are currently failing, declaring bankruptcy, or aggressively shrinking their footprints to survive, the deal flow for Ollie's procurement team is just unprecedented right now.
Okay, let's test the actual mechanics of that deal flow for you. If a major big box retailer files for Chapter 11, what does that actually look like on the ground for Ollie's?
Well, it creates a massive bottleneck of stranded inventory. So overseas manufacturers have shipping containers full of goods floating across the Pacific, intended for a retailer that suddenly cannot pay for them.
Oh, wow. And domestic warehouses are sitting on canceled orders too, I imagine.
Exactly. And the manufacturer has no distribution network of their own. I mean, their core competency is making the product, not selling it direct to consumer.
So they need liquidity, and they need to clear that physical space immediately.
Right. So Ollie's steps in with a massive cash pile, offers to buy that stranded inventory for pennies on the wholesale dollar, and deploys their own logistics network to clear it out.
I'm looking at the broader macroeconomic picture here, though, and I see a potential flaw in that thesis.
Okay, what is it?
Sourcing cheap inventory from bankrupt competitors sounds phenomenal for gross margins. But if the overall consumer base is ultimately tapped out and traditional retail is bleeding cash because people aren't buying, how long can Ollie's just act as a scavenger?
That's a fair question.
Right, because eventually you run out of middle-class shoppers looking to trade down, and you were just left holding a massive warehouse full of canceled coffee makers.
And the bears are aggressively modeling that exact scenario. But the counter-argument lies in the absolute adaptability of the off-price format.
How so?
Ollie's does not have the burden of predicting fashion trends or carrying permanent product lines.
Oh, I see.
If consumer demand for home electronics plummets, a traditional electronics retailer is stuck with depreciating assets. Ollie simply stops buying electronics closeouts and pivots entirely to whatever category the consumer is currently prioritizing.
Like those highly demanded consumables we just talked about.
Exactly. They are essentially a liquidation pipe. As long as there's friction, miscalculation, and failure in the $2 trillion global supply chain, there will always be high-quality goods available at a steep discount.
So the worse the traditional retail sector performs, the wider Ollie's gross margins can actually stretch.
You got it.
That adaptability on the product side is fascinating. But, they still need physical boxes to sell the product in. You can't just pile distressed inventory in a parking lot.
No, you definitely cannot.
And ironically, the same dying competitors supplying the inventory are also providing the real estate. They hit a record 86 store openings in fiscal year 25.
Which is huge because their historical operational cadence was opening roughly 50 stores a year.
Yeah, jumping from 50 to 86 is a massive strain on logistics, hiring, management bandwidth, everything.
And they are maintaining that elevated velocity. They are targeting 75 new stores for fiscal year 26, heavily front-loaded into the first 2 quarters.
Wow. And they just penetrated their 35th state, opening a location in Austin, Minnesota.
Yeah, and they are already laying the groundwork to enter New Mexico.
So they're currently operating 658 stores. But management has drawn a very clear line in the sand regarding their total addressable market.
Right, they believe the domestic runway supports over 1,300 locations.
So they are essentially at the halfway point of their ultimate footprint.
Yeah. And the primary catalyst accelerating this real estate grab has been the systematic cannibalization of big lots.
Oh, man, yeah. As Big Lots shuttered hundreds of locations, Ollie's real estate team moved in aggressively.
They acquired so many of these prime leases so quickly that it actually triggered a $5 million charge on the P&L for dark rent.
Okay, for anyone outside of commercial real estate, you've got to explain dark rent.
Sure. So dark rent is the capital a retailer burns paying for a lease before the physical store is generating a single dollar of revenue.
Right, because when a Big Lots vacates a property, Ollie's cannot just unlock the front door and start selling the next day.
Exactly. They have to sign the lease immediately to prevent a competitor from grabbing the location. Then begins a multi-month process of gutting the interior, ripping out old fixtures, rebranding the exterior, setting up point-of-sale systems, hiring local staff.
There's a whole production.
It really is. And during those months, the building is totally dark, but the landlord is still cashing the rent checks.
So taking a $5 million hit to the current quarter's earnings is a bitter pill for analysts who only look 3 months ahead.
Oh, yeah, Wall Street hates it.
But strategically, it is the only way to lock down proven, high-traffic, suburban retail boxes.
Yeah, because building a new store from scratch greenfield development that takes years of zoning approvals, environmental studies, construction delays.
Taking over a dead Big Lots means the parking lot, the HVAC, and the local zoning are already dialed in.
It is an incredibly capital-efficient way to expand, despite that short-term dark rent penalty.
However, this massive acceleration in store openings created a highly scrutinized anomaly in the fourth quarter metrics.
Right. While the total company comps were strong, the productivity of these brand new stores came in noticeably softer than Wall Street's internal models predicted.
And management's explanation for this softness introduced a really fascinating piece of retail psychology.
They pointed to the collision of a new soft opening strategy and the sheer scale of their loyalty program,
which effectively flattened out their reverse waterfall curve. Okay, let's use an analogy here. It's like a movie sequel, right?
Okay, go on.
So you have massive pre-sales for the Thursday night preview and the Friday opening. Huge numbers. But then by weekend 2, there's a steep drop-off because everyone who desperately wanted to see it already went.
Yes, that is exactly what the reverse waterfall is in retail. Historically, a retailer hypes up a grand opening for weeks.
They drop massive direct mail campaigns, buy local radio ads, create all this artificial scarcity.
And on opening day, you get lines wrapping around the building, the registers print money, and sales volume spikes violently.
Then, over the next 3 to 4 weeks, the novelty wears off, and the sales volume plummets down to a normalized baseline.
That massive spike followed by a steep drop is the reverse waterfall.
But when you are trying to open 86 stores in a single year, engineering 86 massive, hype-driven grand openings is an operational nightmare.
Oh, it breaks your supply chain and totally burns out your regional managers. So Ollie's pivoted. They adopted a soft opening protocol.
Meaning, the moment the shelves were stocked and the registers worked, they just quietly unlocked the front doors. No ribbon cutting, no local news crews.
Exactly. Now, combine that quiet opening with the behavioral dynamics of Ollie's army.
That's their loyalty program, right? With like 17 million highly engaged members.
Yeah, and these aren't just casual shoppers. They are hardcore deal hunters who actively monitor real estate developments in their local towns.
Oh, so they see the Ollie's sign go up on the old Big Lots building, and they literally start stalking the location.
Yes. The moment those doors unlock, the local Ollie's army members flood the zone. They don't wait for a grand opening flyer.
They walk in and immediately start buying up the highest value closeout deals.
And because of this, the massive surge of revenue that usually hits on a single Saturday grand opening was pulled forward and spread out over several quiet weeks.
So the market looked at the initial grand opening weekend data for Q4, saw that it lacked the historical violent spike. It just assumed the new stores were failing.
They thought the expansion thesis was cracking under its own weight.
But management presented a very compelling mathematical defense.
Right. The absolute volume of inventory moved and revenue generated over the first 90 days of the store's life is identical, if not better.
The area under the curve is the exact same.
They simply shifted the timing of the sales. They flattened the reverse waterfall into a steady stream.
I mean, it is a brilliant operational pivot, but it requires the market to have patience, which is always a tough sell on Wall Street.
Definitely.
Let's look at what is actually happening inside the four walls of these new boxes. Because securing the real estate is only half the battle. You have to maximize the revenue generated per square foot.
And that requires severe merchandising agility. Right now, they're executing a massive pivot into opening price point living room furniture.
We are talking about deep discount sofas, sectionals, and recliners.
Yeah. And from a logistical standpoint, furniture is notoriously difficult. It's bulky, the freight costs are astronomical, and it takes up massive amounts of floor space.
But strategically, this move perfectly aligns with their core philosophy of feeding on disruption.
Think about the competitors who just vacated the market. Big Lots, Value City, American Freight.
Right. They all aggressively targeted the lower income and middle income furniture buyer.
And they all either went bankrupt or severely contracted. That created a massive vacuum in the market.
Because there is a huge demographic of consumers who desperately need a new couch, but they cannot secure financing at a traditional premium furniture retailer.
And they absolutely refused to assemble a flat pack sofa themselves from like IKEA.
So Ollie saw that glaring white space and is just flooding it.
But to your point about the difficulty of the category, retail floor space is a zero-sum game.
Right. A standard Ollie's box is roughly 30,000 square feet. If you dedicate a massive chunk of the center aisle to sectionals, you have to evict something else.
Management noted that the hardest discipline in the closeout business isn't deciding what to buy. It is having the ruthless discipline to decide what not to buy.
So to make the math work on the furniture pivot, they are aggressively exiting the wall-to-wall carpet business in more than half of their fleet.
Which is smart. If you analyze the unit economics, carpet is a terrible asset for a fast-turning discount model.
Oh, it's awful. It requires massive, specialized steel racking.
It requires employees to physically cut and bind the rolls, which drives up labor costs.
And the inventory turnover is glacial. I mean, you might sit on a roll of beige carpet for 6 months.
A couch, by contrast, requires zero specialized labor. You put it on the floor, put a disruptive price tag on it, and the consumer figures out how to get it into the back of their truck.
They are also selectively shrinking their traditional toy departments to make room.
Yeah, historically, toys were a staple of the closeout model. But the modern toy industry has shifted heavily toward digital integration, interactive tech, hyper-specific licensed IP.
Which really doesn't translate well to the unpredictable nature of closeout sourcing.
Exactly. So by shrinking toys and eliminating carpet, they free up the square footage needed to dominate the abandoned furniture market.
And they are applying that same ruthless optimization to their marketing engine, too. For decades, the lifeblood of the discount retailer was the massive multi-page front flyer shoved into millions of local mailboxes.
Yeah, the old circulars. But Ollie's is actively dismantling that legacy strategy in favor of a highly dynamic, algorithmic digital media mix.
Because the agility of digital marketing is just non-negotiable at their current scale, right?
Totally. If their buyers secure a massive, unexpected closeout deal on 200,000 branded coffee makers on a Monday, a print marketing campaign is useless.
Yeah, it takes weeks to design, print, and mail a physical circular. By the time it hits the consumer's mailbox, The inventory is already sold out.
But a digital mix allows them to geo-target ads around specific store locations the very next day, driving immediate localized foot traffic based on real-time inventory deliveries.
The discussion around these marketing flyers produced one of the most revealing moments of the entire earnings call for me.
Oh, the Spider-Man quote.
Yes. An equity analyst tried to press the CEO on the exact cadence of their promotional schedule. He wanted to know exactly which weeks they planned to push certain categories.
And the CEO flat out refused to answer. He actually quoted Uncle Ben from Spider-Man saying, "With great power comes great responsibility."
Which, on the surface, being secretive about a retail circular sounds absurd. But if you dig into the leverage dynamics there, why is that schedule classified?
It all comes down to their scale and their negotiating power with vendors. Ollie's is approaching $3 billion in annual purchasing power.
They are no longer a regional player taking whatever scraps they can find.
Exactly. They are a massive market maker in the global closeout industry. If they publicly broadcast their marketing calendar, if they tell Wall Street, and by extension the entire vendor community, that they are running a massive national hardware promotion in week 3 of May, they instantly destroy their own leverage.
Right, because if I am a manufacturer sitting on a warehouse full of excess power drills, and I know for a fact that Ollie's must source hardware next month to fill their advertised flyer, I am not going to accept 20 cents on the dollar.
No way.
I am going to hold out for 30 or 40 cents, knowing they are desperate for inventory to match their marketing.
Precisely. By keeping their promotional calendar a complete black box, the vendors are kept in the dark. The vendors don't know if Ollie's needs hardware or bedding or consumables this week.
That asymmetry of information allows the Ollie's procurement team to dictate the terms of every single deal.
The great power the CEO is referring to is their $3 billion balance sheet, and the responsibility is protecting their gross margins by never tipping their hand to the market.
Man, that transition into gross margins perfectly sets up the most critical piece of this entire deep dive. Section 4 of our analysis, the upgraded financial algorithm.
Yes, this is huge.
Management didn't just report a solid quarter. They fundamentally re-engineered the expectations for their long-term financial model, and they did it with a subtle tweak that has massive compounding implications.
In the world of institutional investing, a management team voluntarily raising their long-term baseline targets is the ultimate signal of absolute confidence.
Historically, Ollie's has guided the street to expect 1 to 2% annual comp growth. On this call, they erased the floor. The new algorithm targets a firm 2% annual comp growth.
And they matched that top-line confidence with a massive upgrade to their profitability targets. The historical baseline for their gross margin was 40.0%.
Right.
The new baseline is 40.5%, and the CEO left zero room for misinterpretation. He stated, on the record, 40.5% is the new 40.0 period.
A 50 basis point expansion in gross margin might sound trivial to a retail investor, but when you apply an extra 0.5% of margin across $3 billion in revenue, the cash generation is staggering.
Oh, absolutely. However, the true genius of this updated algorithm is what they intend to do with the excess.
Yeah, management explicitly stated that if their buyers secure deals that push the gross margin above that 40.5% threshold, they will not let those excess profits flow to the bottom line to artificially pad their quarterly earnings.
That is a really fascinating capital allocation choice, because Wall Street usually demands that every available cent of profit drops to the bottom line.
Right. So why would management intentionally cap their own earnings beat?
Because they understand that extreme value is their only true economic vote. If they generate a 42% gross margin, it means they bought the goods so cheaply that they could have lowered the price for the consumer even further.
And if they keep the prices high just to juice their quarterly earnings, they invite competition.
Exactly. Instead, they take any margin generated above 40.5% and reinvest it directly into price competitiveness.
They intentionally lower the price tag on the shelves to widen the price gap between them and Walmart or Target or Amazon.
They are weaponizing their supply chain efficiency. They are broadcasting to the rest of the retail sector. We have a structural cost advantage that you cannot match. We will use it to suppress prices so low that you cannot possibly compete for this customer, and we will still comfortably hit our 40.5% margin.
It is a brutal, highly effective market share acquisition strategy.
It really is.
Okay, I want to challenge this invincible narrative with the biggest macroeconomic threat currently hanging over the physical goods sector, tariffs.
Ah,
Every other consumer discretionary company is citing potential supply chain shocks and massive cost increases due to impending tariffs. Yet, Ollie's management essentially shrugged it off.
yeah.
Are they delusional, or is their model somehow insulated?
Well, they are not immune to the mathematical reality of a tariff. I mean, if a tax is applied at the port, someone has to pay it.
Right.
However, their strategic view is that severe tariff implementation will cause absolute panic among traditional retailers. And as we've established, panic is the exact fuel Ollie's runs on.
Think about the timeline of a tariff shock. A massive multinational retailer gets terrified that new tariffs will destroy their margins for the upcoming holiday season. They preemptively cancel hundreds of millions of dollars in factory orders overseas to protect their balance sheet.
Which instantly creates a tidal wave of excess inventory. The factories have already produced the goods, the traditional retailer has walked away, the goods are stranded.
So this massive glut of supply crashes the wholesale price of the merchandise.
Yep. Ollie swoops in, buys the stranded goods at rock-bottom liquidation prices, and absorbs the tariff cost.
Oh, I see. Because they bought the underlying asset so cheaply due to the competitors' panic, their landed cost, even after paying the tariff, is still significantly lower than what a traditional retailer would have paid in a normal, stable environment.
Exactly. Tariffs create the exact market dislocation that the closeout model relies upon.
And to execute that strategy, you need massive liquidity. You need the ability to wire tens of millions of dollars to a distressed vendor overnight.
Which brings us to the cash cannon.
Yes, the balance sheet. Ollie's balance sheet is a masterclass in risk management. They ended the fiscal year with $562.8 million in cash and equivalents.
And they have zero meaningful long-term debt.
Which is wild. In an era where legacy retail brands are being suffocated by the interest payments on their massive debt loads, Ollie's is operating with absolute financial freedom.
And they just introduced a highly systematic method for deploying that capital. They announced a firm commitment to return 50% of their free cash flow directly to shareholders via stock buybacks.
For fiscal year 26, that translates into a newly stepped-up authorization of roughly $100 million.
Let's break down the mechanics of why that buyback is so critical to the algorithm.
Sure.
By consistently buying their own stock on the open market and retiring those shares, they are steadily shrinking the total number of outstanding shares.
This creates a mechanical supplement to their earnings per share.
Right. Even if macroeconomic conditions cause their top-line revenue growth to momentarily stall, the shrinking share count virtually guarantees consistent mid-teens EPS growth.
They have engineered a financial machine that generates compounding returns regardless of minor operational speed bumps.
Which provides the perfect framework to synthesize everything we've discussed into actionable context.
Yeah, how should you, as a seasoned investor, look at the Q4 print, the upgraded margin algorithm, the massive real estate acceleration, and the behavioral shift of the consumer, and make sense of the market's hesitation?
Because that tug of war in the stock price, the pre-market euphoria followed by the slow bleed into the close, it shows a market that is fundamentally conflicted.
The long-term algorithmic upgrade, the fortress balance sheet, and the aggressive buyback program offer an incredibly compelling bullish thesis.
But the institutional bears have just enough ammunition to cap the multiple. They are pointing directly at the $4 million top-line revenue miss, and more importantly, they are fixated on the initial softness of the new store productivity.
Even though management logically explained that the soft opening strategy and the Ollie's Army loyalty base simply shifted the timing of the sales curve.
Right, but institutional models hate anomalies. They want the data to perfectly match historical precedents.
Until Ollie's can provide 2 or 3 quarters of clean data, proving that these 86 new stores are generating the exact same total volume as the legacy fleet, the bears will keep the stock on a tight leash.
And the extent of that tight leash becomes glaringly obvious when you overlay Ollie's performance against the broader retail sector.
If you look at the stock heading into this earnings print, it was down about 9% over the trailing month.
That decline roughly tracked the broader retail ETF, the XRT, which was down about 8.6% over the same period.
Because they were moving in tandem with the macro sector in the short term.
But zoom out and look at the trailing 12-month chart. The divergence is massive. Over the last year, the XRT retail ETF is up a staggering 17.8%.
The broader market bought into the soft landing narrative and bid up retail stocks.
But over that exact same 12-month period, Ollie's stock is up a meager 2.5%.
The market has severely punished Ollie's relative to its peers, despite the company printing record store growth, upgrading their long-term margins, and literally cannibalizing their bankrupt competitors. It's a massive dislocation in valuation.
It is a classic show-me story. The market is terrified that rapid unit growth inherently destroys early store profitability.
Because investors have watched countless retailers try to grow too fast, lose their operational discipline, and collapse.
Exactly. They are forcing Ollie's to prove that scaling from 600 to 1,300 stores won't break the magic of the closeout model. The stock is coiled, but it requires pristine execution over the next 2 quarters to break out of this range.
Which brings us to the culmination of the deep dive. The mechanics are exposed, the data is unpacked, and it is time to transition into our signature Talk Tickers closing segment.
The outrageous but plausible trade idea.
Right. Let's set the parameters clearly for you listening. This is not financial advice. We are stepping into the mindset of an aggressive hedge fund manager, pitching a theoretical strategy to an investment committee. We are exploring the absolute limits of the market mechanics we just discussed. Do not execute this trade.
Understood. Let me pitch you a concept I am calling the retail necromancy trade.
Raising the dead. Walk me through the mechanics of the trade.
It is a highly aggressive pairs trade designed to capture the exact transfer of mass happening in the physical retail ecosystem. The first leg of the trade is directional exposure to Ollie's. But we are not tying up capital by simply holding the equity. We want to buy long-dated, out-of-the-money call options on OLI. Specifically, you want the expiration dates timed to mature right at the end of the second quarter.
Why are we targeting the end of Q2 specifically? What is the catalyst there?
The catalyst is the maturation of the data. By the end of Q2, the initial 90-day window for all of those 86 new stores opened in fiscal 25 will be completely closed.
So the reverse waterfall curve will have entirely flattened out and normalized.
Yes. The short-term noise that the bears are currently fixating on will evaporate, and the actual undeniable volume of sales those stores are generating will hit the SEC filings. You are timing the options to explode exactly when management's thesis is mathematically proven to the institutional skeptics.
I follow the logic on the long side. But options decay. Theta will eat you alive if the stock just trades sideways for months. How are we funding the premium for those long-dated calls?
To fund the long side, we construct a highly targeted short basket. You do not short other retailers, you short the landlords.
Oh, wow.
You build a basket of commercial real estate REITs, real estate investment trusts, that are structurally over-indexed to the dying traditional big box retail sector.
You dig into the tenant concentration data of these REITs and find the ones whose largest revenue sources are the legacy department stores and the bankrupt discount chains that Ollie's is currently feeding on. The underlying logic there is vicious. You are essentially getting paid by the market to bet on the physical decay of the old retail guard. As these legacy big box stores file for bankruptcy and vacate these massive suburban locations, the REITs holding the leases completely lose their pricing power.
They are stuck paying taxes and maintenance on millions of square feet of dead space.
Right, and the REIT's cash flow collapses. Meanwhile, Ollie's, acting as the apex scavenger, swoops in and demands bottom dollar rent because they are the only viable tenant left with the capital to expand.
So you short the landlord bleeding from tenant defaults, and you use that capital to go long on the vulture who is scooping up the leases for pennies and flooding them with high-margin furniture. You are extracting alpha from both sides of the retail apocalypse.
The retail necromancy trade. A brilliantly engineered pairs trade that exploits the real estate bottleneck. Again, for you listening, this is purely a theoretical exercise in market mechanics, absolutely not financial advice.
It just demands that you view the retail sector not as a static spreadsheet, but as a biological ecosystem where the violent decay of one entity is the direct required fuel for the explosive growth of another.
Which leaves us with a final, highly provocative thought to ponder long after this deep dive wraps up. We have thoroughly established that Ollie's supercharged, multi-billion-dollar growth engine relies entirely on the corpses of failed retailers.
It does. They require massive macro disruption.
They need a constant stream of canceled shipping containers. They need competitors to declare bankruptcy to secure cheap leases and distressed inventory.
But what happens if the ecosystem fundamentally changes?
Exactly. In 3, 4, or 5 years, if the retail landscape finally stabilizes, the weakest players are entirely flushed out. Global supply chains become hyper-efficient, and the mass die-off simply ends. Where does the vulture get its meal?
If the retail apocalypse concludes and the chaos subsides, does the Ollie's growth engine fundamentally stall out?
That is the ultimate existential question that every long-term shareholder eventually has to confront. Something for you to heavily consider as you watch the retail space continue to fracture and evolve. Thank you for joining us for this deep dive into Ollie's bargain outlet. Remember, none of this was financial advice, just a rigorous exploration of the hidden mechanics driving the tape. We would love to hear your own analysis and theories on the Talk Tickers platform. Until next time, keep your eyes on the data.